You want to build more wealth, right? What about protecting the wealth that you do build? In this video, I'm going to break down 4 main strategies that people use to build wealth and protect their wealth. You surprisingly may not have actually heard of these strategies or know their intricacies, but after this video, you'll be aware and you'll know why they're super important to your financial plan to know about. For the first strategy that you might not know, if you sell your personal residence and you've lived in it and owned it long enough, you may be able to pay 0 capital gains taxes on a generous amount of the profit. It's called the Section 121 exclusion, and it's awesome. I quote from the IRS website, "If you have a capital gain from the sale of your main home, you may qualify to exclude up to $250,000 of that gain from your income, or up to $500,000 of that gain if you file a joint return with your spouse." Your capital gain, also known as your profit, would be the money that you receive for the home minus your cost basis in the home. Your cost basis is the cost that you paid for your home, plus things like sales tax, some legal fees, and more. You can also add to your cost basis certain major home improvement costs, like an addition to the home or replacing your roof. It's important to keep track of these types of expenses because increasing your cost basis will decrease your tax liability. And that's what we want, a lower tax liability. So how do you qualify for a full exclusion of your capital gain up to the $250,000 and $500,000 limits? Well, you need to have owned and used your home as your main primary home for a period of 2 years out of the past 5 years prior to the date that you sell it. You also cannot have taken the exclusion on another home in the past 2 years from the date of the sale of your home that you actually want to take the exclusion on. The IRS doesn't just keep giving out freebies. IRS Publication 523 has a ton of info to help you learn more about this, including more information on figuring out your cost basis. Remember, the higher you can get your cost basis, the lower your tax liability is going to be. Keep track of those improvements to your home. I can't tell you the amount of people that I've come across that had no idea that the Section 121 exclusion was even a thing. I recently actually had a good friend who wasn't told about this exclusion by her tax professional, and she ended up making a selling decision at the height of the real estate market recently because of talking to her about the exclusion. She said it was certainly a contributing factor to her decision to sell when she did versus dealing with renovating her property during a labor shortage. And, well, commodity prices are soaring, so it's good to know that it exists. Now she's going to take that money and she's going to invest it elsewhere. It's something that you want to let your accountant know that you want to claim if they're not automatically asking you the right questions to take the liberty to bring it up for you. Now let's switch gears into the second strategy. But first, we need to start this with a fun finance fact. Even if you have a will that outlines how you want your assets to pass, a will does not prevent assets from having to go through the probate process. You may be thinking, what? What is probate? And I thought that the will protected me. Something that you need to know is people can contest a will and try to get money from it if they weren't in it. And if the will is not done properly, it could lead to assets not passing as you actually wanted them to. So yeah, I know, why turn from tax-free money into death? But it's part of life, and we want to make sure that your assets pass as you wish and stay protected with the least amount of friction, costs, and stress to your heirs, right? A lot of people have a will created, and they think that they are good to go. What they don't know is that a will doesn't prevent assets from passing through a court process called probate. Probate is where the courts validate a will and administer assets accordingly. And if there's no will, the courts decide how the assets will pass based on state laws. Secondly, this is a biggie, especially in the face of privacy becoming more impossible in today's tech world. Probate makes a will public record. Yes, you heard me right. Your will become public record if it has to go through the probate process. So if somebody wanted to get in on the action to figure out your family's business, they actually could. Probate can be a lengthy and costly process depending on the size and the complexity of the estate assets. So there is a cost here. So what strategies help your assets avoid probate and keep people out of your business? The first thing you can do is set up a living trust. This is a trust that's created by an estate attorney that designates where your assets go. No probate needed. Just make sure after you create the trust, you actually transfer your assets into it. Also, once the assets pass to your heirs via the trust, It creates asset protection for them from their own creditors. The second thing that you can do is set beneficiaries on any account that can have one. This is really important. A designated beneficiary trumps everything else. Yes, even a living trust. So go right after this video and check your beneficiary settings in your accounts. If you can set one, do it. Not to mention, check to make sure your old ex-spouse or someone you don't like anymore isn't the beneficiary of your money. The third thing that you can do is set payable on death beneficiaries on any bank accounts that will allow it. Some bank business accounts will not allow a payable on death, but most personal checking accounts will. All right, let's move to the third strategy. If you're eligible for Social Security payments in retirement, the longer you wait to take those payments after your full retirement age, they increase every year you don't take them by 8%. That's a pretty nice raise every year by waiting. So by delaying taking Social Security a few years, you can guarantee a lifelong higher payment. If you have longevity in your genes, this could be a way to strategize not outliving your money. That's why we do retirement planning, because we don't want to outlive our money. Now, if you're wealthy, which wealth, in my opinion, is defined in many ways, but you may not need your Social Security checks. But money is money. And if you can have more of it over your lifetime to live more comfortably or do more charitable giving or whatever you want, it's good to know that this strategy exists to be able to do that. Plus, the fact of the matter is that most people will need Social Security in retirement for some expenses. So this little retirement strategy is quite relevant to actually most people. So here's an example of how delaying Social Security can actually impact the amount of money that you may receive over your lifetime. This is a sample financial plan showing how someone with the certain details that I've outlined could earn $101,000 more over their lifetime, assuming that they live until their estimated life expectancy, of course. But they could increase how much money they earn over their lifetime by $101,000 by waiting until age 70 to take their Social Security. That's a huge chunk of change, my friends. $100K extra over your life can be extremely helpful. Now, here's the caveat with this. If you truly live to your life expectancy or longer, you may have beat the system. Big time. But the risk is that you wait to take Social Security for the larger payment, and then you don't live long enough for delaying it to make sense for you. But your surviving spouse may get that full benefit. So it takes some thoughtful planning to see if it's worth it, but it is a fact that I find not many people are aware of, especially people that are more so approaching retirement age. The fourth strategy is investing in qualified small business stock. It can pay you major tax-free gains. Thanks to the Section 1202 of the tax code, if you invest in qualified small business stock, think investing in startups, or also known as angel investing, you may be able to avoid taxation on 100% of your capital gains when you sell that stock up to certain very generous limits. You may even get a state tax deduction for investing in some states. Keep in mind the business that you're investing in has to be in that state. Now, something to know is that you may not be able to actually invest in some of these opportunities without being an accredited investor. And that means having a certain net worth or a certain amount of income. But even so, some companies can take up to a certain number of investments from non-accredited investors. Just know that the government wants to encourage small business investments, but they also know that those investments carry a lot more risk of loss. So Section 1202 of the tax code helps reward you for that risk that you're taking on. Now, it depends on when you acquired the stock and how long you held it to determine how much of your gain from the sale is excluded from tax. The IRS outlines the rules on their website. Keep in mind a few things. The business must be a C corporation among a list of a ton of other qualifications, but we'd expect nothing less from the IRS. Generally, you have to hold the qualified small business stock for over 5 years, and they cap the exclusion of gains to either 10 million bucks, which is a lot of freaking money, or 10 times your aggregated adjusted basis in the stock. So, like I said, very generous limits that you can have gains tax-free. So, should you run out and invest in every startup or small business out there for tax-free gains? No. Hold your horses. Investing in emerging businesses comes with risk, like I mentioned earlier, and you should analyze the risk to reward the same as any other investment. But I will say this, Qualified small business stock is a gem to have in your portfolio if you can get access to solid investing opportunities. So it's something that's really good to know exists. All right, Finance Fam, these were some of the top strategies that wealthy people use and that you can use too. I found that most people that I talk to aren't fully aware of them, so I thought this video might be fun and helpful. So did you learn something new today? Let me know in the comments below. Don't forget, if this video was helpful, please like it and subscribe, and I'll see you next time.